Hey everyone, welcome to Talking Tokens, a podcast focused on interviewing the best crypto founders, market players, and up-and-coming startups that are changing the industry every single Tuesday and Thursday. I'm Jacquelyn Melinek, your award-nominated host and former senior crypto reporter turned entrepreneur, and I'm excited to be here with you all. Now, let's get into it. Today's guest is Anthony Moro, CEO of the Provenance Blockchain Foundation. The blockchain has over $10 billion in real-world financial asset value locked on chain and has over $30 billion in supported transactions across areas like lending and securitization. The company also recently announced ProvLabs, which is its SaaS and blockchain development company that provides financial institutions, service providers, platforms, and DeFi apps the ability to power their operations on the Provenance blockchain. With all that said, we got a lot to talk about. So Anthony, welcome to the show.
Jacquelyn, thanks for having me. It's been watching you for a while, and it's great to finally be live on the show.
I love that, and I appreciate that. I'm a long-time listener, and now we got a guest. So if you're one of those listeners, this could be you too.
For sure.
Awesome. Before we get into Provenance, can you kind of tell me about your career and how you ended up in the blockchain space? I know you have a background in TradFi. Would love to hear more about that.
Yeah, so I started my career pretty much at BNY Mellon in the late 90s. I'm not a spring chicken anymore. Primarily in security servicing, so learning how Wall Street works. The Bank of New York Mellon is often called Wall Street's plumber. They are by far the world's largest custodian bank. They hold about 25% of the world's investable assets. So understanding how Wall Street works, how securities get moved from point A to point B in a safe and compliant manner was something that I spent a lot of time doing. I also eventually wound up running a large part of the ADR business, which in my look back was one of the most intermediated and expensive securities products anywhere. And I'll give you a quick example. So an ADR is a U.S. security that represents a foreign security trading on a non-U.S. stock exchange. And you've got all the intermediary expenses on the foreign exchange, whether it's France or China or Russia. You have some intermediary expenses when it crosses the border, FX, and then turning share ratios from one to another. And then you have the standard U.S. Intermediary costs on the other side. So, some of the intermediary expenses on those could be tens of millions of dollars for a single ADR program every year. And it's great when you're making those fees, of course. But now that I'm on the other side of the fence here, I see a world that is highly inefficient, and the inefficiency exists to protect investors, to be sure, but there are areas to take fees every step of the way that Wall Street is not ashamed of doing. So what we're doing in blockchain, I think, is the next iteration of finance. We're building the new operating system for global financial services, if you will, here at Provenance, and we're taking those fees out, so I'm paying for my past sins a little bit. So that was the first 20 years of my career. After that, I ran a NYSE listed REIT for a little while and have been at Provenance now for a couple of years.
Amazing. So on the front of the TradFi world, have you had conversations with like former colleagues, people of that nature who are still in that side of the financial institutions, but do you think they have a shift in opinions? Like, do you see them changing their minds kind of maybe the way you have?
So great question. You see it anecdotally that everyone believes blockchain done right is the future of financial services. You even see the world's largest asset manager, BlackRock, dabbling its toes. You see the world's largest bank, JPMorgan Chase, more than dabbling its toes, building businesses on blockchain. And then you've got the rest of Wall Street that is actively looking, trying to understand what the space is all about. We've certainly gotten more calls on the back of BlackRock's Buildle fund because the conversations in the boardrooms went from, we'll keep an eye on it to, oh my goodness, BlackRock just did a fund. What's our strategy? And many of them have them. If you're taking a big step back, when I started on Wall Street, it all comes down to cap tables. Like you're taught this early on. Who owns what? Where, what, who, what, where, when, why, and how. So the cap table is the who and the what and the why, right? So it all goes back to cap tables. And cap tables before my career were kept on paper that was held in a filing cabinet, and then it was kept on a mainframe that was kept in a closet on premises, and then it was kept in a cloud. at an off-premises location, and now it's just on the blockchain and it's distributed globally. And at each step of the new way to hold or ledger or cap table, you have new capabilities, and that's really what we're seeing in this iteration. You can not only ledger a cap table, but you can build an entire you can put attributes around the security, and then you can trade the security and lend the security and do lots of interesting things with it, all in one application. So when we say we're building the new operating system for the global financial services, I mean the blockchain can act as a good control location for a security, and it can move those securities to different parties. You can perfect your ownership in them. You can lend against them. You can use them as collateral. You can hopefully buy and sell them all. And it really does start to take out a lot of the intermediary expenses and make things cheaper, faster, and very importantly, safer for investors.
Mm-hmm. Is that kind of how you explain the differences between like blockchain technology in regards to maybe like settlements, intermediaries, et cetera, what exists today versus what's going on in the traditional financial sector and payments?
Yeah, again, it comes back to the cap table for me. So if I can have a ledger that has an accurate look at who owns what and at what time and what they did, and an immutable history going back, to the beginning of the securities issuance, it really does start to change things in terms of timeframes. Now, Wall Street just went from T+2 to T+1. It's a great step. They can still go to T+0 if they use blockchain because we can have instant finality. There really is no reason that you and I can't trade 100 shares of Amazon between us without the use of the 5 intermediaries that a Wall Street requires in order to settle that trade. And
Right.
while they don't charge you a fee, you can be sure they're not doing it for free. They are taking fees on the
Mm-hmm.
trading side of it. That being said, that construct still needs to come to fruition. I don't think public equities will be a killer use case anytime soon. I like to say the first asset class that has been disrupted by blockchain is what Figure Technologies and 10 of the 20 largest mortgage originators are doing in the home equity line of credit space. Now, for the listeners, a HELOC is essentially a second mortgage. And they're popular now that interest rates have risen. If you have a 3% mortgage, you're not doing a cash out refinance on your existing mortgage, but you are very comfortably taking out a second mortgage to pay for college tuition or putting in a new kitchen. So those HELOCs have generally been roughly the same amount of work as a mortgage for the mortgage brokers, the brokers who issue them, but a fraction of a size. So a mortgage might be $300,000, but a HELOC might be $40,000. And so they never really like to do HELOCs, but they're always very happy doing mortgages, obviously. What Figure and their partners have done in the process, though, they've taken out 150 basis points out of the process of mortgage origination through to the warehouse and then to the ultimate securitization. And by taking out those expenses, they're able to reduce lending rates to borrowers. And so you start to do some societal good by having technology truly be disinflationary. And that's what we're doing here at Provenance. Like if it's a good public blockchain use case, we're all for it, but there are some blockchain use cases that really don't solve a lot of problems, and we're not really focused on those. So there are a lot of markets with a lot of intermediaries that are really messy from a security servicing perspective, and that's what we're targeting first.
Mm-hmm. Yeah, that was going to be one of my follow-up questions, Anthony, is more like what differentiates Provenance from other blockchains? Do you see yourself as like a financially focused chain that wants to bring real-world assets on? Kind of tell us what makes you guys differentiate yourself from like the plenty of blockchains out there.
Yeah, so you're right, there's plenty of there's and more every day with all the meme
Right.
coins being created on Solana. Someone said 50,000 were created last month, which is insane.
Yeah,
But
the token
obviously
front is crazy, but
crazy. But a very different construct
mhm.
from what we're doing. I don't really think of myself in the crypto business. I think of myself in the blockchain business. So
Mm,
Provenance is a public blockchain. It's open source, just like the major blockchains, but very differently. It was built specifically for financial services applications. And what that means is, take a Solana or an Ethereum or any of the other generic blockchains. They're purposefully built to be generic, meaning
mhm,
you can use a bunch of smart contracts to turn them into a metaverse or a game or a meme coin, um, or a regulated financial asset, right? And it's the use of those smart contracts that turn the generic blockchain into a utility for a product. Uh, Provenance is different in that we don't use smart contracts to nearly to the degree of other blockchains, because all of the functions that you would need to put in a smart contract to make the generic blockchain applicable for securities is actually built into our protocol. And when you start on Provenance, you create something called a marker for your asset. And in that marker, you turn on or off all the attributes that you would ordinarily need smart contracts for. So do I want it to be tradable? Do I want a whitelist? Do I want a clawback? Do I want KYC or any of the dozens of attributes that you would need to know in advance when you're creating a security? You have those available to you directly in the protocol, so you don't rely on a third-party smart contract. And third-party smart contracts are fine for a lot of use cases, but my contention is if you pile enough of them on top of a generic blockchain, you have a Jenga tower of risk that isn't going to do very well in the risk committees of the banks and large asset managers. And make no mistake, that's where the decisions to move forward or not on any particular security are being made, not necessarily in the boardroom. It's in the risk committee meetings, who can oftentimes overrule the board if they don't like the risk construct of a particular program or asset. So we built the blockchain with risk first and foremost front of mind, and as a result, we're gaining, as I said, a lot of traction. We're by far the world's largest real-world asset blockchain, with now over $11 billion in assets. We added $1 billion over the last 45 days. And just to give you some perspective, about $1 billion has been issued in the tokenized treasury market in its entire history. So we're not only growing fast, we're growing faster than the rest of the market combined.
All right. I got some follow-up questions for you. Firstly, $11 billion is no small feat. How do you think Provenance was so good at being able to scale to that amount? And what do you think is kind of accelerating it right now?
So it was purpose built by Figure Technologies. Mike Cagney and Juno, who were the co-founders of SoFi, left SoFi in 2018 to found Figure, and in the process they created the Provenance blockchain, and they created a lending business around it. And that's largely 95% of the $11 billion in assets are Figure markets, Figure lending assets, and their partners. They're a B2B2C. You can go to figure.com and you can take out a HELOC, but you can also go to Movement Mortgage or Guaranteed Rate and take out a HELOC or a mortgage. And when you're doing that, you're using the Provenance blockchain and the Figure underlying technology that isn't necessarily blockchain technology, but works and ledgers the loans on the blockchain. So it was purpose built for that function. And that's sort of the Amazon books, we think, of the market, because the revolution will happen asset class by asset class. And the first asset class, as I mentioned, was HELOCs to be disrupted. I think if you're issuing HELOCs and you're not using blockchain technology, you've been disrupted. You just don't know it yet. So I think you just can't compete with that kind of savings at the end of the day. So yeah, Figure built it. The Provenance blockchain foundation spun out in 2021 in its current form, and is tasked with making what Figure has done using the pioneering path and technology that they built, and making it available to others. So now we're working with lots of other companies following that path. One is doing tokenized life insurance on the blockchain. One is doing aircraft leases. One is doing intellectual property. So we've got lots of cool use cases coming out, just following in the Figure footsteps.
Yeah. So on that front, which other different asset classes do you think are on chain right now that you see the most opportunity for? And which ones are not on chain that you think should be coming on chain?
So the ones we're focused on, we're really focused in three areas right now. Knowing that public equities will come at some point, but not for a while. So I mentioned loans, and there's a whole host of loans. Private credit in general is a great asset class, because you save money, you save intermediary expenses, you save time by sharing the ledger and then moving through that process. Private funds done in the right way are a killer use case. And not all private funds are going to be good on blockchain, because you're not going to get secondary market liquidity for a private fund because of the legal construct of the fund anytime soon. You're not going to get more distribution just because you put it on a blockchain. It doesn't make the asset any sexier from an investment perspective just because it's blockchain. And a lot of people have that thesis. I don't see it, but they do. Being able to, so if you go buy an Apollo fund, for instance, you're generally locked for 7 to 10 years. And you invest $1 million, and your money sits there, and it comes back, and it's a lot bigger at the end of that 7 to 10 years, but you can't do anything with it during that time. So a killer use case for blockchain is being able to have your ownership in that fund perfected, and then have a NAV loan issued to you for 20 or 30 or 40% of the value of the NAV. So then you can use, the asset isn't just sitting there. You can then use, $200,000 to go invest in Bitcoin, or go, again, pay off your its mortgage, or whatever you want to do with it. It unlocks capital, so it allows capital to work, but it unlocks some of it on the backside. And we're excited by that. We're going to have a press release out in the next couple of weeks that announces that process. So that's two. And then the third one, we like all things around receivables on blockchain. So we're working with several companies in that space as well. And the reason receivables work well is because when you share a ledger, both the asset owner and the asset borrower have perfection on each other's liability.
Mm-hmm.
The way factoring is kind of, if you've ever done a factoring loan in the real world, your interest rates might be 40% because the debtor doesn't believe that the creditor doesn't believe that the debtor can shop around the same factor to multi different borrowers. There's no trust in the system, is my point. With blockchain, you can replace trust with truth, and the liability of the creditor is absolute. So wonderful blockchain use case, and we're excited to see that industry vertical play out. So those are three good use cases. Bad use cases are not bad use, but things that are harder to scale or things that aren't digitally native and it's hard to project. So where the real world has to transfer into blockchain, it gets a little bit tough. So someone was giving me the example of someone had to put a dipstick into a tank and take a picture of that and then upload that picture to the blockchain in order to prove that there was a certain amount of oil in a tank.
Right.
And
That's funny.
it's fine to use the blockchain for that, but the blockchain doesn't really do anything in that case that a database couldn't do. So if the asset can be spun up digitally native, like a HELOC, like a receivable, like the right kind of private funds, then you can do things with those assets. With the picture of the dipstick, it's hard to do anything with those assets.
It's a fair point, but we're not in that industry, right? That's not what Provenance focused on. When it comes to conversations you have with traditional financial institutions, service providers, etc., the ones who don't get it yet, what do you think is stopping them from getting this like aha moment or realizing exactly what we just discussed?
So the industry has never lost an opportunity to shoot itself in the foot.
Mm,
People conflate cryptocurrency, FTX, and all the other debacles with blockchain.
hmm
And probably rightly so. I mean, the industry just, any early industry is going to have its bad actors, and crypto has seen more than its fair share. So that's problem number one. Regulation uncertainty is problem number two. Things like SAB 121 getting a President Biden veto made no sense to me whatsoever. Of all the things to care about in this world, really. It's Congress's job to make laws. They're trying to make laws, and sorry, get shut down by the president. It makes no sense. Fit 21 is a step in the right direction. It's not going to get passed as a law, but it's at least giving a construct. It's coming. It feels like Washington has finally gotten its act together and picked a side that for the U.S. to continue to innovate, for the U.S. dollar to continue to dominate. Blockchain is going to need to play a fundamental role in the global financial system. And if our leaders here, every other country is very happy to be a leader and take our place. So I think that's sort of come to fruition a little bit. We're not obviously not there yet, but it's moving in the right direction. So I'm excited about where regulation is going. I was not. If you asked me a year ago, I would have been pretty depressed. I would have said that it was a major hindrance. I think, as I said, it is moving in the right direction. And then the third reason I would say is just lethargy. I think there's a lot of people who are the intermediaries, and they realize they're going to become disintermediated relatively soon, and they want that to not happen during the twilight of their career. So you have some senior people who are going to continue to push back and say, not for us, doesn't make any sense. We like it the way it is. We like our fees. And they do.
Of course, they love their fees. Yeah, exactly. Okay, out of all the conversations you have, though, following that, like what percentage would you say are interested or building strategies internally on this front?
I would think every large asset manager and every bank has had conversations on blockchain, and it's varying degrees of strategy. I don't think you can be a reasonable member of the board and not ensure that your company has a strategy. Billions and billions, if not trillions of dollars of market cap will be disintermediated by blockchain in the next probably 10 years. It's not going to happen as quick as some prognosticators have said. I've seen, $16 trillion by 2030. I think that's wildly ambitious. But it's going to be trillions, probably 1 or 2 or 3 trillions of dollars by 2030 instead of 16, but still a large number. And these things happen slow and then they happen fast. So going back to the HELOCs, again, if you're not issuing HELOC on blockchain, you're doing so 150 basis points more expensively than your competitors, and you just can't compete. And I think once we see that across more asset managers, and certainly the banks and the financial servicers, they won't be able to compete. So things will happen slowly, and then they'll happen fast.
I think also when you bring up metrics like that, it's a no-brainer. Like, why would I not? You know?
Yeah.
And
It's
yet,
the secret formula is cheaper, faster, and safer. Blockchain is great at cheaper and faster. It's terrible at safer.
Well, we're working on it. We're working on it. Speaking of safer, you also mentioned Provenance has risk in mind. That's not something you always hear with blockchains or people building in the space. So what does that necessarily mean? And what do you think other blockchains out there are lacking on that front?
Yeah, so good question. When I say safer, I mean,
this podcast is sponsored by Galaxy. And if you're immersed in the world of Web3, Galaxy is a name you need to know. As a decentralized super app with an impressive 21 million users boasting over 100 million monthly transactions, Galaxy is elevating its impact with Gravity, the magnet chain for Web3. Gravity is designed for full chain abstraction, zero knowledge proof-based privacy, and rapid transaction speeds, all coming together to offer an unparalleled user experience. Gravity opens the door for developers to effortlessly build on the largest on-chain distribution platform, and for users, it promises an even smoother, more secure journey through Web3. It's not about being on-chain, it's about being on the right chain every single time. Galaxy is on a mission to onboard the world to Web3, and Gravity is the magnetic force that will propel that vision forward. Ready to launch your Web3 journey? Build the future on Gravity. Visit gravity.xyz for more information.
Provenance needs to be considered a good control location. And a good control location is the Wall Street term for custodian banks or brokers. It just means when you need your assets are available to you. The network never goes down. I always have access to my assets. And the rest of the crypto community doesn't think of blockchains in that way. And I'll give you something that will highlight it immediately. So if BNY or State Street or Northern Trust, if their computer systems went down for 5 hours in the middle of the trading day, Wall Street grinds to a halt and their stock prices go down materially. I mean, 50, 60, 70%, I have no idea, materially. Other blockchains stop printing blocks, go down for 5 hours in the middle of the trading day, and their tokens stay the same. Sometimes they go up. It tells me something very clearly that nobody is thinking about those blockchains as a good control location. If it's just my meme coin, maybe I can trade it later. I'm not super worried about it. And these are institutional grade assets we're building for. Counterparty risk is a material risk, and smart contracts have counterparty risk. Centralized layer twos have counterparty risk. There's just a whole host of counterparty risk in blockchain as it's built today for generic purposes. We try to take as much of that out as possible at Provenance and make it, again, a good control location for regulated financial services.
No, that makes sense for sure. I guess on that front, why are people not doing that then?
Doing what?
Is it too, other blockchains, why are they not doing necessarily what you're doing?
Because there's
too much work.
No,
they don't
it's not too much
account
work.
for it. Yeah.
So we would not be a good place to build a meme coin. We would not be a good place to build a metaverse or a game, because the construct of how you come onto Provenance is you create your asset. The first thing you do is you create your asset, and it's a more complicated process from an initial. So it's a little more complicated in that it's different, but it's a lot simpler in that it's built for financial services, right? So it's but if you're creating a game, it's not the right technological construct for a game on Provenance. So I don't know why anyone else would create a financial asset on any other blockchain. But for all the other use cases, absolutely, the other blockchains are probably better than us.
I've actually spoken to other founders or CEOs of other blockchains who have very specific visions and drives as well. And they say like it's so easy to get distracted by the shiny things and be like, oh, I want to go join this hype or that. But it's so much better when you're grounded and holding on to like what your mission truly is.
Yeah, you need positive unit economics at some point, right? Not
Mm,
today, but at some point, the validators need to make money when they're using compute power to validate. And other blockchains, it seems, will never have positive unit economics, but they've done large, token offerings, which Provenance has never done. But they use the cash from those token offerings to subsidize what they're doing, and they're also awfully inflationary. Um, and I don't ever get what that business model is on some of the other blockchains. I'm sure it works for them right now, but I don't see how they ever get to positive unit economics. And if you don't get to positive unit economics, how are you ever truly worth anything? If I can sell you $1 for 80 cents all day long, but at some point I'm going to need to make money, right?
hmm Yeah, we gotta bring you guys on for a little debate, see what they have to say.
Sounds good.
Okay, shifting gears a tiny bit, Anthony. Your company also announced ProvLabs. Can you kind of tell us more about that? What was the driver behind launching it?
So we're super excited about ProvLabs, and our construct is probably inverse of most other blockchains. So most other blockchains were a group of developers came together, they formed the labs version of their team. They built a blockchain, they did a large ICO, and then they incorporated a foundation in Switzerland to try to get around how we test.
Mm,
We, as I said, we never did an ICO, so we started with the foundation when we spun out a figure. Now we're offering the labs business, and the labs, the foundation is obviously a not-for-profit. Labs is going to be a for-profit entity that helps build asset servicers, asset issuers attach into the Provenance ecosystem. And the opportunity is really predicated on two facts. First, as we talked about, the global financial markets are going to tokenize several trillions of dollars of assets over the next decade. And second, asset issuers and servicing firms, we think, are going to need a lot of help managing the transition.
hmm
So that leaves us with two questions, where and how. So for the where, I think we look to the TradFi networks for guidance. And from credit cards to custody banks, we know that a global oligopoly of providers inevitably evolves because of security and interoperability and regulatory pressures. And frankly, we think the same thing will happen in DeFi, and a very small number of public blockchains will be used to register and ledger and exchange the world's financial assets. Within this construct, we think Provenance is perfectly positioned. It's the only major layer one purpose built for financial services. It's already ledgering several times more real world assets than the rest of the blockchains combined. So we think that's the where, and the how is why we develop ProvLabs. It's building a suite of foundational infrastructure SaaS products that enable financial asset issuers and servicers to transact on Provenance, and it's using the roadmap and the institutional grade infrastructure that Figure and JP Morgan and Apollo and other originators have used to scale quickly with a wide range of use cases.
Okay. Well, you won't be working necessarily with ProvLabs though directly, right?
So I'm going to be moving out to ProvLabs with most of our
Oh,
team.
there we
Yeah,
go.
big scoop. No, we have a quarterly foundation call. We talked about that. So
hmm
yeah, ProvLabs is exciting. The protocol will continue to evolve, and there'll be, like every other foundation, anyone can add to it because it's open source. It'll be
hmm
coordinated by the foundation, but the interaction of financial services firms will probably be through Of course, anyone can connect anytime they want, but ProvLabs will have infrastructure and tooling that makes it a lot easier and cheaper to just connect into the blockchain.
And does your position or role change at all when you transition over to ProvLabs?
No, I mean, I'll move from the CEO of the foundation to the CEO of Labs.
All right. Well, there we go. We might have to change the
Totally.
title of your position in this episode.
Yeah. Right now, I'm both.
Amazing.
Technically, I'm both right now, but I'll move once we get full fun out. I'll move.
There we go. There we go. Earlier, Anthony, you talked about the regulatory situation, and we will definitely get into that in a second. But I also want to talk about the approvals of like spot Bitcoin ETF, the spot Ether ETFs. Given that there are a lot of institutional conversations here, how do you kind of look at these SEC approvals of those two more recently on the crypto industry, on institutional players outside of it? Do you feel like this gives a little bit more validity to the space then, like you said a year ago, you were like totally bearish on the idea of regulatory uh, institutional like development on this front. But now maybe has it
Yeah,
changed?
a year ago, I would have bet against both Bit and ETH ETFs. I thought they were never going to happen until the SEC came out with comprehensive crypto rules. The rules in crypto are just it's new technology that the 30 the SEC the acts 33 and the 34 Act, the 40 Act don't encompass. They just don't have a construct to make a foundation or a layer one a security. I can go into the details of why, but it doesn't exist. So a year ago, I thought the SEC was going to come in and say all the foundations are securities, start filing 10Ks and 10Qs, which they can't do for obvious reasons, for lots of reasons. So that's where I was a year ago. But Bitcoin came through, which was awesome. And then you could see, the argument for Bitcoin, because Bitcoin is digital gold. It's not really a business on chain. It is completely decentralized. I don't even think it has a foundation. Maybe it does. I don't
No,
think so.
there's people who contribute to it, but yeah.
Yeah. So I can see Bitcoin, but then with ETH, I was like, blew me away. Like, I would have said 25% last year for Bitcoin and zero for ETH. And now both are done. So don't bet with me. So yeah, and then when ETH, I mean, it's still not done. The S1s still need to be approved, but it looks like it's probably 99% right now. Yeah, Ethereum is a business. It has unit economics. It's very decentralized, but it's you could argue either way on that. Is it a security? Is it not a security? I'm delighted. I mean, I couldn't be happier that the SEC is granting it the ETF for Ethereum because it looks Ethereum looks a lot more like Provenance than Bitcoin certainly does. So we're super psyched. There'll be more. If there's Ethereum, there will be more. I would like the SEC. I would love the SEC to put some guidance out onto what decentralized means, and just define some of these terms that got them over the hump. And then also tokenized deposits for the banking system. Proper yielding stable coins in the SEC construct are things that are needed for the ecosystem to grow, all of crypto to grow. The stable coin as a payment rail is not where it needs to be. Again, largely because of counterparty risk. These things aren't bankruptcy remote. They don't pay interest. You take risk of the issuer. All things that aren't going to scale in mass. So these are some of the problems that still need to be solved. I know there's lots of solutions working on them, but they also need to be solved in a U.S. construct. Mountain Protocol and other things outside the U.S. are great, but they're in their current form, they're not going to come into the U.S. So we're excited about the space. Actually, Figure has an S1 filed for Figure Certificate Corp for a S1, meaning a U.S. registered stablecoin that yields Treasury, so 5%, and is tradable peer to peer. So we're very excited about that. If that thing gets through the SEC, that's going to start to change the space materially for the better.
Have the SEC approved anything like that before?
Not yet.
Okay, so how are those conversations going? If you could share.
Yeah, no, it's not. It's Figure. It's not Provenance. So
Yeah.
all we hear is the updates that Mike Cagney gives on his investor calls.
Right.
They seem to be moving in a positive light. I think the SEC. I would guess, it's just a guess. I would guess that the SEC wants to have a SEC registered stablecoin under their control that files Ks and Qs and is audited. Right?
Audited, yeah.
It's just the right thing to do.
No, I know. I'm saying audited because that's like, something people do voluntarily in the crypto space, but it's not fully required.
I mean, the SEC registration process, I've been through it many times. It's not difficult, but you have to be professional about it. You have to be, there's Sarbanes-Oxley Section 404 and other things that, you just have to operate your company with an eye towards risk, which is what we've built from day one here.
No, that's super important. On that front of the regulators, do you see a future where they would be more comfortable with blockchain technology, not just in implementing guidelines, regulations, etc., but actually using it? Or do you think we're far off from that?
I mean, it's just technology. I mean, it's the next iteration of the database. I don't know why there's this whole scary narrative around what blockchain is. Yeah, I get the frauds. The frauds are
Hmm.
very, very real.
But
And
every industry has like bad actors, fraudulent players,
yeah,
etc.
they don't
Yeah.
have their. I guess Bernie Madoff was
He wasn't in
Jeff
crypto.
and Bernie Madoff. Charles, if you were doing postal stamps in the like 1920s, it was Charles Ponzi, right?
Mhm.
These things, I guess these things do come and go. It's just crypto's toxic because of that.
Mhm.
We have a lot of fences to mend because of that. But yeah, again, they're for going deep into into crypto. There's if you want to ledger a cap table, you have a stock transfer agent. There's some SEC regs around a stock transfer agent,
Mhm.
and the debate is would they allow the use of blockchain technology or not? And they haven't been openly promoting projects using blockchain as the ledger. Um, and the question is, why? You don't have to talk about any other technology that you use in any other stack.
Mhm.
Um, but for this one case, you do. And Rob Morgan of the USDF Foundation, which is a firm we're a part of, was on Capitol Hill last week with several others talking about blockchain technology, and he made that case exactly. Is in with a bank, any of the banks have to get regulator approval before engaging in any project in any way, shape, or form, sandbox or otherwise, with blockchain
Yeah.
technology. And he was, as far as he knew, it was the only technology, the only time they ever asked a question about which technology are you using.
Hmm.
Um, and it's yeah, again, the banks are highly regulated institutions, and you have to trust that they're doing the right thing. And then if they can't meet their obligations because the technology broke, obviously they're not meeting their obligations.
Mhm.
Um, and again, if blockchain can be seen as cheaper, faster, and safer, you do have an obligation to allow banks and asset managers to use it because it's cheaper, faster, and safer. Who wouldn't want
Mhm.
that?
I think it's a big miseducational situation where they just need to be better educated on this, and then they could actually see the value of it the way some of the people that you've already worked with do, right? And then if it provides the ability to do it cheaper, faster, and safer, I think those were the three words he said. Again, why wouldn't we do that? But the safer piece isn't always there
No,
for a lot of blockchains today.
most blockchains just don't. They think cheaper and faster is enough, but
Hmm.
when you're retail trading a coin, it doesn't really matter. Retail just doesn't seem to care about this stuff, even though they
Hmm.
totally should. Institutions do, but not enough. So the next big iteration what Figure Markets is using is MPC wallets, multi-party computation wallets, which sort of start to disintermediate the custodians, even the crypto custodians,
Hmm.
because now you truly own your own key in a disintermediated way without centralization. Um, and in that construct, truly, I can trade to you. I can trade 100 shares of Amazon for the corresponding amount of stablecoin to you without anyone touching our assets. And it really does start to blow up. Introducing broker dealers, prime brokers, clearing agencies, DTC. You can make a case that you
Hmm.
don't need any of that anymore. You need a
Well,
you
maybe
need a
that's the
marketplace.
problem, right?
Well, that is a
Like
problem.
that
Of course.
scares them that we could just literally wipe out all these jobs,
Yeah,
everything.
totally. It scares a lot of people.
Yeah,
It scares
I
me a
mean,
little bit.
fair. Yeah, yeah. Especially if you're working in that space. But there's also the idea of like human error or human misuse where people do start to like, mess with balance sheets or tables or whatever it may be that, smart contracts or blockchain technology could solve for.
Yeah, for sure. I mean, it's truth
Yeah.
versus trust, and,
Hmm.
the whole Wall Street is built so there are multi parties in the trust chain,
Hmm.
and if you can replace trust with truth, you can remake all these markets and have them bilateral. It does. Blockchain does two things really well. It replaces trust with truth and allows two parties to transact bilaterally.
Hmm.
And nothing else we've had, no other technology iterations before that have allowed those two things to happen. This one
Hmm.
does, which is why it's so scary.
Yeah. What do you think is the timeline for something like this? Like for blockchains to actually replace trust with truth?
Well, it happened in HELOCs. That's the first asset class.
Right. But I'm saying
um,
like across the board.
it's going to be asset class by asset class. It
Hmm.
will accelerate as it moves, um, but it's going to take many, many, many years. So people say, is it the growth of the internet? I think it's more like the growth of ETFs. So ETFs are at like $8 trillion today, but it took them like 25 years to get there. It started off slow, and now the only way that you would invest in a fund on the NYSE or NASDAQ really is an ETF. No one's really doing even launching mutual funds anymore. So it was cheaper, faster, and safer an ETF, right? I don't know about safer, cheaper and faster. Cheaper, faster, and better taxation.
Sure. Whatever keywords we're gonna throw at
those
it, yeah.
those are the three things for an ETF. Yeah, I think that you'll see similar rise. So several years of slow, and then explosive.
And what about for Provenance? What kind of role do you want it to play in the blockchain ecosystem as a whole? In the next, say, let's say near term, like a year, and then long term, especially in the crypto blockchain world, that's like 5 years. So we'll go that route.
Yeah. So I think, as I mentioned earlier, I think projecting out maybe more than 5 years, but 5 years-ish, like in TradFi, I think we're going to have an oligopoly of providers. There's 4 or 5, I think there's 3 or 4 custody banks that custodize 80% of the world's assets. There's the 2 credit card, 2.5 if you count Amex, credit card networks that manage all those payments. In my depository bank example, there were 4, BNY Mellon, JP Morgan, Deutsche, and Citibank. So I think we'll have the same construct in the blockchain that ledgers financial assets. I would say there'd be one, but I think country tensions, et cetera, will ensure that there's more than one. But there might be 5 or 4 or 3, but there's not going to be 60. And those 5 will be interoperable with each other, so it won't really matter. You won't really care what blockchain things are being tokenized on. And you'll trade on decentralized marketplaces that have active market makers and real-time pricing updated on any asset that you want to trade. And then you can transact bilaterally. I think that's where it's going. It makes sense from a securities perspective. There'll be ways to get leverage, perpetual contracts, et cetera. There'll be all different trading strategies and constructs available to you. But if you just want to trade 100 shares of Amazon from me to you, we'll be able to do that as well. So that's the longer term. The shorter term is keep plugging away and building. So first batter of the first inning is really where we're at. There've been some, the industry is great at press releases. I think who's keeping the press release people in business here, and announcing things that they're going to do. So we try to announce things that we've done at Provenance. It's hard because there's a lot of pressure to get out in front of everything because again, the press release craze is there. But I think a year from now, we continue building heads down, continue to be the largest asset blockchain in the world and accelerate that and stay focused where we're at. I think we're in a great spot, and I think it's only going to scale from here.
Yeah, amazing. I'm excited to see what happens next for you guys.
Me too.
To wrap things up, Anthony, can you tell us something else that you're watching in the crypto world right now that you think people should pay attention to?
Yeah, I'm going to go back to the ETFs because I think it is a seminal event in this industry. I think it becomes mainstream. I think you start to get, and I think we saw this with the state of Wisconsin's pension fund, right? I think they're the first one to buy the Bitcoin ETF. I think you start getting 2-3% digital assets in large portfolios, and that brings in hundreds of billions of dollars of assets into Bitcoin and Ethereum. I think you'll get a fund of funds up at some point as an ETF that will go out and buy a basket of tokens. Yeah, it's just a matter of time. And that happens when that scales. It scales. I think is Bitcoin going to replace the U.S. dollar? I don't know if I'm that much of a Bitcoin maxi, but I think it's good for the U.S. in general because it will put pressure at some point on the U.S. political class to lower debt. You can't just keep printing dollars forever and think there'll be no competition ever. We'll see. I don't know if we'll ever get that far, but we'll see. But yeah, I'm a big fan, and I wasn't, honestly 3 years ago. I'm late to the party, certainly. But I'm a big fan of Bitcoin. I think Ethereum has a role to play, and I think Provenance is going to rule the roost. We're listing our token finally after a couple of years later this year. It's called Hash. We have not listed it because we haven't had a retail use case. We're trying to stay true to the law. We didn't want people speculating on it. But now that Figure Markets is live, it's a proper retail use case, and we have some other things that are also retail use cases. So we're gonna look for hash on Figure Markets website, their centralized decentralized exchange, and then also on some centralized exchanges towards later on this year.
Exciting. There's a lot
Yeah,
to look forward to here then.
for sure.
Last thing, Anthony, always ask my guests this. Can you leave us with a piece of advice, something that you've carried with you throughout your time in this industry?
Good call. So it's so early. We're in the first batter, the first inning of certainly financial services on blockchain. I can't really speak for crypto as a whole. But tokenizing several trillions of dollars of assets over the next decade is a massive opportunity. It is remaking Wall Street as we know it. The transition will be violent because there's a lot of people who don't want it to happen. But it's going to happen because at the end of the day, if cheaper, faster, and safer always wins. It just has to. It's economics. So heads down, do it right over the next year plus. Do the right things. Don't lie, steal, or cheat. Build good product that people want, and let's revolutionize an industry.
Love that. Amazing. Hopefully our listeners are not doing any of those bad things. But yes, thank you, Anthony. I appreciate that. And thank you for coming on the show today.
Thanks for having me, Jack. This was great.